Good afternoon. This is Mike Bertelsen, the Bear Market Investor, the market update for February 7, 2011. We're here looking at the S&P 500 stock index in the 15-minute time frame. We're also going to be looking at the Volatility Index as well. First, let me draw your attention right away to the wave structure. That again has us completing a wave 4 here at the end of a running flat correction. Very difficult to pinpoint, but that's why this looked like a first impulse wave down, because it was 5 waves down. But unfortunately, it was the end of a running flat, not the end of this rally. So, that said, we had a wave 4 of 5 of C completing at this level. After that, let's go ahead and count the waves, knowing that under this best interpretation, we are in the 5th and final wave of the correction from the March 2009 lows. That means with perhaps one more push to the upside, probably tomorrow, we will see the conclusion of the entire bear market rally. Whether or not that concludes tomorrow or does extend longer remains to be seen, but it does look to be pretty likely we're going to see that top put in tomorrow. Now, let's go ahead and count our waves again. We have a wave 1, a wave 2, a wave 3, actually a wave 3 right here, a wave 4. That puts us in a 5th wave right here as well. That means that we are in the 5th of the 5th of the 5th of C. Now, to add even more fun to this, as I had noted, we're expecting probably another push to the upside tomorrow. What that means is that we are probably entering in to the 5th of the 5th of the 5th of the 5th of C. And that will conclude the entire bear market rally. Now, this is using the best Elliott Wave analysis that we have available to us right now. The best Elliott Wave count. There are corrections in Elliott Wave that can take many different avenues. Understanding Elliott Wave analysis and continuing to revise your count is necessary. There is never a point at which you can be satisfied that the count, as you see it, is 100% solid. To that end, we cannot be sure with absolute 100% certainty that this will end the rally from March 2009. But we do have this count. This count is quite solid. This count has a lot of merit to it. I cannot see any flaws whatsoever in this count. But new information could change that. Now, with that said, we are expecting a conclusion to the rally probably tomorrow. Let's go ahead and examine in the 2-minute chart what we might see. As you can see, this structure here looks very similar to that last wave 4 that we were looking at. It had a steep sell-off for the degree of trend. At this point, it looks like we may have begun the 5th wave. We cannot confirm that yet, but it is likely. So we're waiting to see tomorrow what that brings us. But I do want to say that this is the most solid count that I can provide you. We have probably begun that 5th wave. Now let's jump back to that 15-minute chart again. I just want to show you the parallels between this whole correction, this 4th wave correction, and what we had here. This looks to be just one smaller degree than this correction right here, and that's exactly what it happens to be, as well as that rally is of one smaller degree than this rally. As we can see with our MACD histogram and MACD here in the 15-minute time frame, that is in essence confirming that. The RSI and the stochastic, you could draw some different conclusions from those, but based on the degree and price, we have to assume that this is of smaller degree. So, that said, we're looking for a conclusion of this tomorrow. I just wanted to show you how similar this was to the correction that we just had today. So, tomorrow may be the big day. Tomorrow is the day you want to have your game face on if you are a bear and you've been sitting on this capital waiting to short the market. Use caution, use your own judgment, but using the wave structure, we can at least have a highest probability outcome. Now, should it turn out to be something different, we'll have to look at that point in time. Technical analysis is under constant revision with every analyst that looks at anything, as is fundamental analysis. You need to continually update your charts. You need to continually look at that new data coming in. So, using the data that we have, we're expecting one more push tomorrow that will probably conclude the entire rally from March 2009. What I'd written in my blog today was that we did at least have the possibility of, and there is not, of course, any information to say that isn't the case yet, but I would say it's lower probability than what I've just talked about, and that is that we actually did conclude that already. I just don't think so. This wave structure looks too similar to what we had here, and that little brief push up, although it could be the fifth wave that we're looking for transpiring tomorrow, it probably isn't. It's just too small, and we didn't see that RSI reset enough. So again, we're looking for that fifth wave to be put in tomorrow. Let's go ahead and jump into the volatility index. Now we're here looking at the volatility index in the daily time frame. Let me draw attention right away to this candlestick. This is a potential reversal candlestick. I do think there's still a potential that we could head back down to put in a triple bottom in the volatility index at this level. However, what is so fascinating about this candlestick is that the market was up today. The volatility index was up today. We put in a reversal candlestick here on the volatility index. Now, we found support here at this level. So there is a possibility that even if we have some weakness in the volatility index tomorrow, it doesn't lead down to this level. That remains to be seen, as we are expecting a push in a final wave to probably conclude in the S&P 500 tomorrow. So be on guard. Volatility index may not actually get there. Hard to say. But I just found it so fascinating that we actually had an up day in the volatility index and that we had an up day in the market. That type of thing does not happen very often, and it's kind of a big warning flag that pops up in the market when that type of thing happens. So, just another confirmation of where we are in the wave structure and what we're looking for to happen very, very soon. Seeing indications like this suggests that we are very near a point of reversal in the stock market, and that we are very near a point where we're going to see a surge and volatility that sticks. And we are looking for, inevitably, candlesticks like this to potentially erupt, but that are not quickly reversed. So there we have it. Let's go ahead and take a look at the markets tomorrow. Hope everybody has a great day. I should also say, do please comment on the video or give a rating on it if you like it. You know, some of the folks have done that, and I really appreciate you know, the comments that we've had so far and the thumbs up and everything like that. It's just nice to see. I don't really expect anything for the making of this, but it just makes me feel nice to know that people do appreciate what I'm giving them without really expecting anything in return. There's a lot of investment services out there and technical analyst services out there that do charge money or ask for donations. I don't do any of that. I mean, maybe eventually I'll you know, build enough of a base and think, hey, you know, maybe it's worthwhile to invest some more time in this, and maybe donations would be nice. But I'm not expecting any of that right now. I mean, this is totally something I do because I enjoy technical analysis, and I like giving back to the dialogue on technical analysis and showing people how it works and trying to get people interested in it. It's really something that is quite eye-opening, especially if you're used to very traditional methods of fundamental analysis. But fundamental analysis is far different from technical analysis. Now, I understand both, and I understand economics and things of that nature. I'm an Austrian person from in that school of economics, and I understand all these different things, but I tend to not pay as much attention to the fundamentals of the companies in the stock market, primarily because the fundamentals tend to fail you when not used or not tempered with technical analysis. So I'm just not much of a fundamentals person. Doesn't mean I don't understand it. But back in the 2007 peak, the fundamentals of a lot of these companies in the stock market were great. You know, they certainly weren't anything that would make you believe that the stock market was just about to crash. But it did. Technical analysis through a lot of the indicators could tell us that before the fundamentals ever would agree. Likewise, going into March 2009, the fundamentals of a lot of these companies were horrible. Yet the technicals, when looked at it properly and in context, showed us that the market was probably going to rally, and it was going to probably rally quite big, and it did do that. It had made believers out of a lot of people that this market, this rally here, is here to stay. And all I'm trying to do is show you a different perspective. It's my perspective, but based on historical data in technical analysis and wave structure and things of that nature. That's why I'm bearish. Bearish in the long term. We've been in a big rise here since March 2009. Like I said, it's made a lot of believers out of the bulls, and it's beaten the bears into utter submission. We may see the resurgence of the bear here, perhaps beginning as early as tomorrow. Have a great night.